Okay, welcome everybody to the Smart Money live chat today. We've got some special guests. We have something new for you today, December 29th. I'm going to introduce you to Andrew Packer. He is our analyst here at the Wall Street Reporter, and he's going to introduce you to a special guest. So let me bring Andrew on. And Andrew, say hello.
Hello, thanks for having me on. Great to be here.
Okay, everybody watching, we got a bunch of people watching, so guys, be gentle, be nice. We're going to open up for comments, and let's meet our special guest. Andrew, you want to bring him on?
Sure thing. Dave Skarica, thanks for joining us today from the Bahamas. How are you?
Good. Thanks for having me. And just as a warning, because we were talking about this off air, we have had a few technical issues because I am in the Bahamas, and my setup isn't my normal setup because I'm doing a house renovation, so I kind of had to plant myself in my living room instead of my office right now. So,
David, as long as we have you, we're glad to have you. We're going to have some great Q&A from the audience. I'm going to leave you two alone, and I will see you guys in the next live stream.
All right, thank you.
Okay, perfect.
So, David, just by way of background, I mean, we've worked on some gold newsletters. I was thinking about you kind of earlier this year when gold first hit $2,000 an ounce. Kind of what has been driving that? What do you see happening with gold prices going into 2021?
There's one of my technical issues. We'll solve that in a second. But anyhow, with gold right now, I'm still really bullish. Like I actually, I was for years been predicting things about, with the debt crisis in the United States and national debt being out of control. And at some point, you're going to see a big devaluation in the dollar. And at some point, I think the stock market bubble will end as well. So I've thought for years we were going to start a major bull market in gold, almost, or you could say restart. We kind of started it back in '99, and then gold moved higher into 2011. And then we had really what was a 7-year consolidation into 2000, roughly, I should say 5 to 7 year, to 2016 to 2018. And then we really moved higher in 2019 and then exploded higher this year with COVID and all the responses to it with money printing and massive government spending and all of this liquidity added to the system. So I think, I'm really bullish. I think we've just seen a consolidation since the summer. I think what's taken it away is that you've seen this big rise in the stock market. So kind of some of that fear trade that maybe happened after the initial decline in the market this spring came out. And then seasonally, for whatever reason, gold is always weak usually too, from August, September to November, December. And anyhow, so I think we're through that seasonal weakness. And now, we just saw this $2.3 trillion government spending bill and stimulus passed. And I think we're going to see another 2 to 3 trillion when Biden takes over. So when that happens, I think you're really going to see gold move significantly higher. And I think another thing that's going to help gold is that finally when this equity bubble bursts and stock market as a percentage of GDP has never been higher, even during the 2000 bubble. So it means the market compared to the actual size of the economy, which is called known as the Warren Buffett indicator. So I think that we are going to see this kind of cause this move in gold. And I think, so when I'm talking about when the equity bubble bursts, I don't think that crypto or Bitcoin is the currency hedge. A lot of people think it is. If you go look at the way it traded in 2017, 2018, crypto kind of gets frothy when the stock market gets frothy, and then it sells off. We had a 20% sell off in 2018 and crypto got hammered. And crypto didn't really do much in the initial stages of this kind of recovery in the stock market in the summer and this year. But now that everything's frothy, we have these IPOs just like 2000, we have everything going nuts. We are kind of seeing crypto blow off. So I think that if the crypto, bubble 2.0 kind of bursts, then really the only game in town is going to be precious metals as a hedge.
Okay. And do you have some sort of specific price target where you would expect gold to reach, or where you would say, okay, now gold's getting overpriced, that's starting to look like a bubble?
I would think I just always been looking at that Dow to gold ratio. It's okay. Let's see. It's okay if I share the screen, to show a chart.
Yeah.
1 second. Let's see if we can see it because I am frozen right now, but looks like that is working actually. So let me go. I'm just going to quickly throw this up. So right now we've got gold at, here at almost 1900. It looks like 1900 actually is representing some kind of short-term resistance. Really that 1900 to 2000 since the spike in the summer has gone higher. But the Dow to gold ratio basically says, I'm just going to quickly put this up here. It basically says that gold peaks when that ratio hits about 1 to 1. And we can see we're about 16 to 1 now. And if we go back, I can go back to 1980 in this and show everybody, when that ratio peaked then. And then we can see right here, the Dow to gold ratio was almost 1 to 1 when gold peaked at 850 and the Dow was roughly 1,000. And then actually, I talked about that bull market starting in 99, it went over to 40 to 1. And then it went back down to about 7 to 1 during the 2011 top in gold. And now we're at 16 to 1. So it really matters, I think, what kind of, because I think we're getting some kind of bust here. If it's inflationary and hyperinflationary, and the type of debts we're running right now being, 138% of GDP in the States, 150%, including the states and local governments, that is setting up for some kind of inflationary move in the markets. So, some inflationary move in the economy. So, if it's inflationary and the Dow goes like to 100,000, something like what's happened in Argentina or Venezuela, then yeah, gold, I don't know, can go to 50,000. But if it's deflationary and you see a bear market in the Dow and it falls 50% because we are so overvalued, then, then it could be, closer to 10,000, which is still a 5 to 1 return. I'm a little more bullish on silver because silver is more speculative. And again, later in these bull markets, silver tends to outperform. So maybe silver won't outperform in the next 6 months, 12 months. But if gold goes up for like 3 to 5 years, I think silver near the end of that move will outperform. You can't time these things exactly. And again, talking about this being a consolidation, I know people don't think in 5-10 year terms anymore. But again, when you look at the Dow to gold ratio going from 40 to 1 to 70 to 1, and just backing up to like 21, 22 to 1, again, you're kind of just taking away maybe half of those gains that gold had compared to the Dow. And now you've kind of consolidated and now you're moving higher.
Okay. And I mean, this is an interesting chart too, because you're talking about the stock market being its most overvalued on sort of earnings. I'm looking at like price to sales, price books. I'm seeing the same thing.
Ridiculous.
But on this chart, I mean, stocks could still go a lot higher and, relative to gold and still kind of not be at that, 1999, 2000 tech bubble peak.
Yeah, I think that 99, 2000 level, and especially if you ingest gold for inflation, let me just put up, a 40-year chart of gold. And when we look at this, right, you can see that gold moved from, because you don't see that intraday spike. But anyhow, the price high was 850 in January of 1980, and it moved down to 250 roughly in 99. Well, of course, adjusted for the inflation over those 20 years, it was even lower. So that was really a secular low in gold. And then it moved to about 1900 and then pulled back to about 1100. And now we're back kind of at those highs of 2011. Of course, again, adjusted for inflation from 9 years, we're actually lower. But what that really looks like, again, just looking at the raw data, just the nominal gold price, it looks like that we've seen this kind of consolidation, and this chart kind of shows it. Like the longer term chart, just like, oh, that's a pullback. If you had a stock go from 200 to 1900 and then back to 1200, you'd be fine with that, right? So it's kind of like we just saw this consolidation and then a base for a few years, and now we're kind of breaking out of that base. And I think another thing, just from a macro standpoint and a psychological standpoint, people who don't know things about, understand debt or the economy, they just think right now, oh, once COVID's over, everything's going to go back to normal. But I think, you're seeing a lot of these cities empty out, and the economy is going to be still hurting for years and years and years. And the government, 10 years from now whenever, or 5 years from now, whenever the next recession occurs, because they're running up all this debt and they're about to do even more stimulus, they're not going to have the facilities to deal with the next recession. And I've always said that, in 2008, the government bailed out the banks, but in the next recession, who's going to bail out the government, right? So I think that too, when you see this kind of erosion in the economy longer term, and that's what kind of happened in the 70s, that maybe 74 was the bottom of the economy, right? Just like, 2019 or 2020 in March, April could have been the bottom. But because things didn't really recover that well and inflation took off, gold continued to move higher from 74 into 1980. So I think we're going to see kind of a similar scenario here.
Okay. Really talking inflation, which is, pretty massive to contend with. But at the time, we've also got a lot of people saying that there's going to be deflation because you have people who, haven't been able to make their rent payments for several months. And, in the US, we had this moratorium that's getting extended. Part of the reason for another stimulus was to put more money immediately into people's pockets. And it does seem like because we have, debt-based money, so once you get to a situation where people can't make their cash flows and make their debt payment, deflation seems likely to occur. So, how would you weigh the risks of higher inflation rates versus continued deflation or having to fight deflation?
I just think that if we do get a deflationary period, and again, I'm not going to keep showing charts the whole thing, but if you go look at the CRB or other commodities, and not just gold, like we're actually seeing the first upward move we've seen probably since about 2010, 2011, after the financial crisis, when there was, again, short-term disinflationary period. So I think that if we do kind of see this deflationary period, like let's say, like the market drops 30, 40%, like it did in March, April, or like it did in 1987, and everything kind of gets hit, again, they're going to fight that. They're going to print money. They're going to monetize all the debt. They're going to come up with more infrastructure and stimulus projects. So I think that any kind of deflationary scenario is not longer term in orientation. It's going to be more, short-lived and then followed by fighting it. And then another thing I think that you're really going to see with this is, well, let's say, because you said people can't pay their rents, they can't pay their mortgages. Let's say if one of the ways they come out to fight this is with, UBI, like universal basic income, right, using MMT, modern monetary theory, essentially printing money to fund these gaps, these budget gaps, to give people money in their pocket so they can pay their rent. Again, that's going to be hyperinflationary. So I am an inflationary guy right now. Again, I can't count out that once this equity bubble is pricked, that we're going to see a short-term 3-6 month period of deflation, similar to what we saw, earlier this year for the first 3 or 4 months. But I just think that ultimately the solutions are always going to be printing money, and they're always going to be monetize everything. Remember that I think the next round of QEs after any kind of short-term bust doesn't just restrict itself to buying corporate bonds or government bonds. They're going to be buying bonds from, they're going to be buying ETFs. The Japanese central bank has been buying ETFs in Japan for years and years and years. So they're going to be buying all of these things. And, we're going to see some sort of, inflationary movement and everything. My real question is, after any such bust, does everything get inflated? Because if you're in kind of a stagflationary period like the 70s, the stock market can kind of underperform. But if we go worse than stagflation and our debt problem, both at the consumer, corporate, and government level, are way worse than where we were in the 70s, then the market will go up with everything. But what will happen is gold will probably just go up quicker than the market as well. So that's my only real question is. Now, I'm a little different too, because I do a lot I'm kind of do a lot in venture capital. And I'm, being from Canada, original being Canadian, there's a big venture capital market there for, junior mining stocks. And I help finance companies and consult with some of these companies. So for me, gold and silver is more of a no-brainer than being in the stock market or being in crypto, because I also have this kind of access to deal flow and investing in these kind of smaller micro, small cap gold and silver miners. So that also is, and that's where I am too, by the way. I don't really own the Barricks or the Newmonts. I own kind of these smaller miners, which have more leverage in a gold and silver bull market.
Well, I mean, that actually kind of some interesting questions, because we are, viewers here, like, should we buy or the mining? What do you see, kind of more important? Obviously, the bullion makes sense for safety. However, things like the gold mining stocks are going to have a bigger percentage return.
Yeah, and again, if you go look at, we're talking about these ratios and other ratios, just comparing like HUI or the XAU to the price of gold, and the gold miners relative to the price of gold are still, really, really cheap at the moment. So that's another aspect of this, Andrew, is that the mining stocks are relatively cheap. So I think you need a mix, though. Obviously, if you're a baby boomer, I'm in my early 40s, so I still have time to be very aggressive. I can still be mostly in the miners, but I think you want to buy the bullion. Like, if you're kind of a survivalist and you think everything is going to hell in a handbasket, and I'm not a total doom and gloomer like that, but like, do you really want crypto? Because the worst case scenario is your internet and electricity and everything's out. And crypto's not going to do you a whole lot of good, whereas, you can barter with your gold coins in that case. So I think, the conservative, you want to own the bullion. If you do own the bullion, I much prefer to own the bullion through the physical rather than buying the GLD or something like that. And then you want to own the major miners, because what will happen is, one thing that's great about the major miners right now, the big miners, they really deleveraged after the 2011 top. So they got rid of debt. They paid down their debt. So a lot of them, I think, are going to become dividend plays. I think one reason that Warren Buffett bought some Barrick in the summer, even though he sold some of it, was Barrick was starting to pay a very nice dividend now, because they've paid down so much of their debt over the last 8 years or so. So I think those big miners actually become dividend plays, and then these smaller miners that I'm talking about, either the smaller production companies or the pure juniors, they're where you want to be, for kind of your capital gains or your Vegas money, because that is a very, very volatile industry. So I would say with those, like, I would only have 5-10% of my gold portfolio in those if I'm the average person. So I guess I would do it like 40-40-20, like 40 billion, 40 the larger miners, and 20, 10 to 20 of the smaller miners. And again, depending on your risk tolerance, I'm not a financial advisor. There's the full disclosure, but how old you are, how much time you've got left, what, obviously your income, can you afford to lose this money? If you can't afford to lose a dime or lose a big sum of your money, then I wouldn't be doing the juniors at all. But that's kind of what I would do right now. I think you want the miners here because they have much more leverage right now. And as soon as gold gets above 2,000, you can really make a lot of money mining gold at 2,000.
A lot relative to the stock market are just so much, kind of more off their highs. They feel a lot less toppy than everything else going on. They feel a lot less just kind of overbought. And
again, if you look at them from a charting standpoint, the HUI peaked at around 370 in August, and it's about 300 right now. And by the way, so that's another warning about the miners. They're really volatile. Like, if you go look at the 2000 to 2011 bull market of the miners, there was even a 70% drop in 2008 and plenty of 30, 40, 50% drops. So there are 20, 30% drops. That 20, 30% drop it happens like almost on a yearly basis, even in the bull market. So you have to understand these are volatile securities, but also they have a lot more upside. I think from 2000 to 2011, gold went roughly up about 7 times in value, and the HUI index, I think, went up nearly 20 times in value. So it went up almost 3 times what the bullion did. So that's another thing here. I would think that from these levels, if gold, let's say for argument's sake, went to that 10,000 and you made 5 times on your money in gold, you're probably going to make 10 or 20 times. And then that's just in the major miners. Like these smaller juniors, people are interested in them. Yeah, I do a lot of them in my publication, Addicted to Profits. They can run up, like I've had one, and don't worry, not everyone does this, obviously, run up almost 20 times in value in just the past year. So like there's more leverage in those as well. So actually, and one philosophy I've told people to do, if your list tolerance is a little lower, but you want to do some juniors, just have a higher cash percentage in your portfolio to kind of buffer against the volatility in these junior miners. So right now I'm a little more leveraged to the gold mining equities, but I do think you need that bullion as kind of a core of your portfolio. And the bullion's even more like appealing now in terms of a large cap asset, because you don't make any money in corporate bonds. You don't make money in government bonds. The S&P doesn't pay a good dividend. So people's argument against gold is always, oh, it doesn't pay an income, doesn't pay a dividend. Well, guess what? The U.S. 10-year bond pays less than 1%. The 30-day T-bill pays nothing. So that makes bullion even more appealing because you're not getting any interest or dividends off anything else.
Well, it's not just you're not getting interest. It's the government's going to keep printing money. It's going to keep throwing money kind of at the economy till hopefully something sticks and it works. And it just doesn't really look like we're necessarily there yet. You've got some states that are going into more lockdowns. You've got some that aren't, but you still have, essentially a very kind of, challenging economy, and one where, politicians are, very tempted just to keep throwing money at it. They don't really care about the deficit. They don't care about that. And it definitely seems very favorable to gold. But you've also mentioned silver. So how much do you think silver is likely to move kind of relative to gold? What kind of returns can you expect there? Because that seems like if there's great opportunities in the junior gold miners, maybe a silver player might be, one of the best trades for 2021.
Yeah. Like I have a few. I actually have one silver deal that I'm again doing one of these products. I don't want to mention it because these and they get the newsletter for that because these are very small cap, micro cap companies. So I don't like to mention them on shows such as these. But yeah, or even if you something like Coeur d'Alene, which is disclosure my family owns. These things again can go up a great deal. Especially we're kind of in the sweet spot now where right now they can make good money, but if you go from 25 to 35 in silver, that is all profit for a silver miner. Like that 40% move in silver, probably a silver miner could go up. And I mean, I'm talking one of the larger cap, companies like that, they could probably go up 3 or 4 or 5 times in value on just that 40% move. So yeah, I like silver. And again, there's something called the gold to silver ratio. Right. We mentioned the stock market to gold ratio. So as cheap as gold is compared to the stock market right now, or nowhere near a high, the gold to silver ratio, which historically trades at about 50 to 60 to 1, it takes 50 ounces of silver to buy 1 of gold. It's like 70 to 1 now. It actually went to over 101 during the crash of the markets this earlier this year, which is, by the way, an all-time high. So silver was never that cheap as compared to gold back this March, April. But 70 to 1 is still a cheap level, and it went, I think, to about 15 to 1 during 1980, but that was because the Hunt brothers cornered the market and the whatnot. But like usually at a high, it will go to like 30 to 1. So let me give you an example of what could happen then. I've talked about this gold 10,000 price. Well, if that were to happen and we get this 30 to 1 ratio, that means silver roughly goes to 300 an ounce. Silver is 25 right now. So you're talking that's 12 times on your money, where gold is only a 5 times trade from here. So I think that, and because silver tends to attract, because it's lower price, it's cheaper, it tends to attract more of the speculative type people near the end of a precious metals bull market. So it should outperform as we mature and we attract more kind of speculative money. Like I would argue, people say trade the FANG stocks or the tech stocks or crypto right now, they're going to be more likely to be in silver and the silver equities than gold and gold equities. And silver's got such a small, global market cap, just a small amount of money. Like if every institution in the world decided, let's put 1% of our money into silver, that would blow a hole in the price. Like it would just go up like crazy.
Yeah, I mean, I kind of remember that sort of anti-banking kind of plan for everyone just to buy silver in 2011 and to kind of bankrupt ideally JP Morgan, which is one of the big kind of like silver brokerage players. Obviously, that didn't happen. Obviously, some of these big banks will trade futures contracts that can sort of impact the price. Do you see that as a potential source of manipulation or something that might kind of impact profitability?
What do you mean, silver in general, or?
Yeah, I mean, because you have the physical silver, but then you also have sort of this paper market where someone could just go out and just, sell a bunch of contracts, push the price down short term. Is that something you could see kind of happening to try to sort of derail a monster rally before it even takes off?
I think that can hold it back, but I think ultimately that won't work because we've seen that in gold and precious metals itself, that maybe, these kind of shenanigans that go on in the paper market hold it back. But it seems to me ultimately gold will move higher if there's higher inflation and all these kind of fundamental things end up mattering. So I don't know if that's going to really kind of derail it. And on the other hand, you could argue if they're going to try to manipulate the price and short the contracts and whatnot, if there is some kind of surge, they got to scramble to cover, right? So, and I think they're going to be less likely to do that because I know they've lost a whole bunch of these lawsuits and had a whole bunch of fines.
Right.
So I think that they're going to be less likely to be in there with shenanigans and the whatnot. And also, as this gold bull market matures, there's a couple deals I'm in that have done very well. I'm talking these smaller cap deals, but now they're to the point where, because they've had good drilling results, they're starting to go into production. They're becoming $500 million companies or $1 billion companies instead of being little $50 million juniors. Well, guess what? Wall Street gets access to if they want to list on the NYSE. You'll have more precious metal, IPOs, etc. So then that would make them even less likely to want to manipulate it because,
Right.
Most of where Wall Street makes its money is off fees and, listing fees and, and underwriting fees, etc. So I think that will ultimately kind of help it as well.
Okay. Now we've gotten a couple of kind of questions from viewers here, just kind of on what specific stocks that you own. You've mentioned Coeur d'Alene, CDE. Are there any other of kind of these small?
I like Eldorado a lot as kind of it's kind of like a mid-tier type company. Because when the new government came in Greece, a more conservative government, they got the permitting for their Greek mine, which is a very it's a high-end mine with a low cost of production. So I like Eldorado. If someone's really conservative, you're probably going to look at the royalty companies. I don't own these, just so you know, because I am a little more aggressive with my own money. But Franco-Nevada, Wheaton Silver, these are the kind of things that these companies do. They basically invest in other companies, and they get a stream of income off the properties. Royal Gold is another. And the great thing about that model in the gold and mining sector is you're Agnico Eagle, which is a company I like, by the way. But if or Barrick, and you get some kind of accident at your mine, you got to shut down that mine. Where if you're, Royal Gold or Franco-Nevada, you've got interest in 20 producing properties, and you're taking a 1%-2% off the top line. Well, then if one of those properties goes offline, it's you're losing your little royalty on one of these 20 or 30 properties that you have. So those are pretty good for investors that are more conservative.
Okay.
The one that I do kind of like, it's called Victory Metals. VMX is a junior. They're doing a merger with a company called Nevada King right now. And that, as disclosures, I do own shares in that. And I am raising the money on the financing they're doing at the moment. But anyhow, what I like about Nevada King, it's going to be the fourth largest landowner in Nevada. So that means that only Newmont, the big boys, are bigger than them.
Okay.
And their goal is to take over more properties to become the second largest. And that makes them, they can do so many things with those properties. They can drill them themselves. They can spin them off and do joint ventures with other companies. It also makes them a takeover target for a major at some point, because some major, the amount of gold reserves has collapsed since 2011 because of the lower gold prices. No one was drilling and no one was finding big reserves. So that makes them a takeover target, because a larger company might say, well, with all the properties these guys have, they have the potential to have a lot of ounces in the ground that we need to use to replace ours. And also Nevada is historically one of the premier, safest places to mine. One issue, you have in mining, is you may have these great properties and mines in Africa, in some areas of Asia. If anyone's ever seen the movie Gold, which is basically loosely based off the Bre-X fraud, That was one of the problems that BRICS had, is they were dealing with this corrupt regime in Indonesia. And actually the movie was pretty accurate in terms of what kind of happened there in Indonesia. But anyhow, so being in Nevada is really a huge deal. If you see properties in places like the States, Nevada, Utah has some mining properties, Canada, especially Quebec, is in Ontario, are good jurisdictions. And then Chile is one of the best jurisdictions in the world, probably the premier one in South America for mining. I think these are, if you're someone, again, who's a little more averse to risk, you want to be in these areas as well.
I mean, are there any countries you absolutely wouldn't invest in a property just because of the political considerations, or,
Right now, I had someone who tried his oil and gas, but tried to do something in Sudan, and that was a lot of empty briefcases. Actually, one of the most, one of the most infamous ones was a company called Crystal X, and they were in Venezuela. And that property that they owned, which was this mega huge property, it changed. Actually, different companies essentially were bribing officials there. And this is way before this current regime. This is back in the early 90s, and that property kept changing hands. And now, after years and years and years, and now Venezuela being in kind of total collapse, that property just no one's ever going to produce it, even though it's one of the largest unmined gold properties in the world. So. Venezuela would be one. I don't know. Some of these African countries aren't as bad as you would think, because they are looking for investment, because they need some kind of foreign dollars for coming into the country. But I'd probably stay away from the Congo. But there are some countries that you have to know. I'd stay away from South Africa right now, because I think they're going the way of Zimbabwe, unfortunately, in terms of ownership restrictions, possible nationalization, etc. So those are the kind of the ones that I would stay away from. But a lot of African countries are actually okay. But what I would say is, number one, you're going to get a lower valuation because the political risk gets priced in, and so you have to realize that, because you may look at this company that's in Africa producing all this gold, and you might say, well, how come a company producing the same amount of gold actually at a higher price, your cost of production in Nevada has got a way higher market cap, because the Nevada company has a premium because of the company does not have the political risk there.
Right. You pay a little more for stability, but that's also kind of your margin of safety. And if you expect gold prices to keep going up anyway, you're still going to benefit from that with a junior miner as a leveraged play.
FCO. Let me go look.
Yeah, got some questions coming in on.
She said fabled, and I'm like, do I even? It's called Fabled. And I said, I don't know. This is the kind of company. It looks like this thing just started trading, and it's kind of a new deal. It's 9-10 cents. These are the kind of things. Like, one reason I would comment on Victory, which is going to become Nevada King, is because this company has an over $100 million market cap. It's going to be liquid. It probably will get a listing on a major exchange at some point. I'd have to look at this, because there's a million of these juniors. I don't know what they all are, but again, this is the kind of company, just so you know, that, like I said, I don't know anything about it. I have to look at it. It's a 9-cent stock. You have to know about the management team. You have to know about the properties. You have to realize this is a very micro cap, small cap, which is going to be extremely, extremely volatile. And I know that when I invest in any of these sort of deals.
Right. Yeah. I mean, my view on penny stocks is, you buy a little, you learn about it, take swings when you get them, because there will be those big swings. Gives you a chance to dollar cost lower, maybe take some money off on a big swing. But
like for example, sorry, I didn't mean to interrupt, but penny stock that I own, my family owns, is Galani Gold, GG.V. And it's a 23-cent stock. It's got about a $40 to $50 million market cap, but they're actually producing over 30,000 ounces of gold a year, right? So that's something that even a little more. They're in Africa right now, right? But they're in a couple of pretty stable jurisdictions. So, but those are the kind of things I think that you said penny stocks. If someone is going to speculate in a penny stock, they kind of have to do it, with that sort of thing. I I do it in a company that's maybe got production, et cetera. And by the way, when I do the penny stocks too, I'm not just throwing darts at a board. I've been in that penny stock arena for 20 years now. When I started out, I started doing the conference tours, meeting people. So most of the guys I'm doing stuff with have a history of selling properties to others, putting the properties into production, selling the properties to majors, et cetera. So I'm not just, I'm not just kind of investing in any little penny stock that I see.
Right. And it sounds like you're not just looking at kind of the financial numbers, which many times might just be kind of pro forma and on, expected results, especially with a junior miner, but you're talking with management that and getting a sense from not just these companies, but from some of their competitors or people who have properties nearby on kind of what these places might be like. Yeah,
that's a perfect example. See, and also too, you have to understand the dynamics of that junior market. Like you have what ends up having they call like area plays. So what they'll do is a company will have a big find, right? And then a lot of companies around them will like prospect and get properties around them. And like, this is kind of just a trade, but you might know then the companies like when Bre-X was happening, other companies in Indonesia at the time when Bre-X before it was found to be a fraud, we were having hundreds of millions of dollars market cap just because everyone thought Indonesia was this fantastic jurisdiction where you're going to find all this gold. So there are other ways you can trade it like that too, knowing like, okay, this company ABC just found something in this area of Canada or this area of Chile, and then the companies that set up around them are going to do well. But that's more of a trade than a long-term hold. And actually, juniors themselves are more trades. Actually, there's, because they have to raise money, they have to dilute to kind of stay alive. And Doug Casey's kind of famous newsletter writer, he has a great term for them. He calls them burning matches. And just like a burning match flames out, a lot of junior miners flame out because, it's not like Barrick who keeps continuously going to produce gold. Right. If these companies can't develop the project and it costs so much money, they can just essentially, end up going under. And some of them don't survive some of the downturns in the market, et cetera. So you have to find all of those kind of things. But like I said, I think mostly if, even Peru's actually become a good jurisdiction as well. Actually, someone mentioned a stock I like there in Peru is SCCO. Southern Copper, that's a copper, but they also have silvers and offshoot. And that company's done phenomenally. They play a really good dividend. And that's probably another deal I like as well. And by the way, I like base metals too. Again, in some kind of stock market decline, et cetera, I can see the base metals selling off. But I think with the economy going to be weak, and then with countries looking to stimulate, there's going to be infrastructure projects and all this thing, which will create demand for iron ore, copper, steel, etc.
Okay. Yeah. I mean, that all makes sense as part of this sort of inflation play. Getting some questions, what about uranium? I would probably also throw in, what about kind of like oil, gas, some of those kind of commodities as well.
I like uranium because I guess it has a bit of a green offshoot, because as long as you don't have an accident, uranium is actually the cleanest energy in the world, like the inputs, because the people don't realize the battery technology and all these inputs to build, windmills. It's all very intensive in terms of, like the battery technology for solar and green needs lithium and cobalt and copper and all these other things. I think Elon Musk even said something a few months ago about he wanted the copper production around the world to be ramped up. So how green is that, right? But anyhow, I think the thing that when you're looking at these other things like uranium, if a country decides, okay, we're going to make this part of our green energy solution, and whether you agree with the global warming or climate change argument and green energy in general, it is going to go that way, especially with Biden now in power. And I'm from Canada, and Mr. Trudeau is a total green proponent. So I think if a country is willing to take uranium as part of that, you're going to see that uranium price continue to move higher. And we're seeing places like China and India building a lot of nuclear reactors. It's still a little faux pas in the West, but I like uranium. It has had a big run, And my only other kind of warning about uranium is, well, is green play. It's also an alternative play to oil and gas. So again, if you get another, like we talked about, maybe the potential of being a short-term deflationary move, and oil and gas go back to, they're not going to go negative again, but if they go to $30 a barrel, well, uranium is going to get hit, because whenever that happens, the solar stocks sell off, the wind stocks sell off, the uranium stocks sell off, because all of a sudden they don't look as appealing as an alternative when oil and gas prices are cheap, you know? But I don't know, maybe another offshoot is the Biden administration, and this has happened in Canada with the oil sands and Trudeau, if they really start clamping down on the regulation for fracking and oil and gas production, and they can do it by just, I don't know, adding some kind of tax or just more red tape, making it a bigger pain in the butt, well, then all of a sudden the oil and gas production in the United States will fall, and that may help, you know, uranium or solar stocks or things of that nature.
Okay, that makes sense. Now we're also getting some questions from our viewers here. Nickel, rare earths. Is this kind of in the same boat for these inflation trades, or are they sort of their own thing that are dependent on like geopolitical events?
Geopolitical rare earths are really interesting. Rare earths are something where I might like a specific stock in rare earths. Like for example, this VMX stock, they actually, their property, Nevada King is all gold and silver, but they actually do a type of produce a metal that's using reinforced steel, right? Okay. So things of that nature, I like the stocks better, because most rare earths come from China right now, and rare earths are going to be very strategic, especially with, you know, this ramp, you know, like UK wants to make all their new cars electric by, I think, 2035, right? So if countries do that, it means that you need more lithium and rhodium and all the things of this nature. So with rare earths, it's actually not so much the price. Obviously, the price will fluctuate as well. It's more that if everyone does want to go towards, again, these green energies, and that's going to take battery power, and lithium is like huge for battery power, I think you want to look at more specific companies. Now, most of the rare companies are small cap, they're speculative. There's no real big boys, because I think something like 80% of the global production for rare earths comes out of China right now. But I think that what that's going to mean is there's going to probably be incentives for American production. Chile produces quite a bit. So does Australia. I think that to kind of find their own rare earths, to link in their own supply, to become, just like the U.S. has became self-sufficient in oil over the last 10 years, they're going to want to become sufficient in rare earths. So with rare earths, more than like, I don't think there's an ETF that tracks them anyhow. You're going to really want to look at individual companies rather than looking at, sorry, I just lost my train of thoughts for a second. Yeah, individual companies rather than the actual price of the rare earth themselves, because it's almost impossible to do. Another perfect example is, even though it's a precious metal, is palladium, and it's used in catalytic converters and other rare earths and rare earth driven technologies. It's basically controlled by Russia. So if you're going to buy palladium, you have to realize that when Russia decides to cut back the production, that's why palladium has these huge price spikes. Because I think 70 or 80% of the global production of palladium is in Russia. So there is a company called Lithium Americas Corp, which I think is mostly in South America, that's had a great run. It's gone from $2-3 to over $11. I don't know if I'd buy it up here, but that is one rare earth play.
Okay. I mean, it's nice to know that there are a couple of options outside of China. Obviously, in the past, they've occasionally cut back on their exports on that and have really just caused the price to go gangbusters. So owning some of these names where they're outside of that space makes sense. We've had a couple of other comments on Bitcoin. You've commented a little bit kind of on the cryptocurrency side of thing. It seems like you think that's part of the bubble too, and not necessarily the store of value that gold and silver is.
Again, this is where it becomes difficult, because what happens if there is some kind of deflationary move? Bitcoin sells off of the market, but then they hyperinflate everything. Well, Bitcoin and other cryptocurrencies will probably do very well in that kind of reinflationary, hyperinflationary trade. So yeah, I think that Bitcoin is fine. I wouldn't chase it up here, but like, yeah, I think, like when Bitcoin was 7,000-8,000, I liked it. Like I own one small company in Canada. Again, I don't want to mention it because it's one of these really small cap companies. Someone can write me on my newsletter or something, but it actually is interesting because it mines Bitcoin and they can do it for like 3,000-4,000 Canadian, a coin. And then also they actually supply the energy themselves. They have like a natural gas production in Alberta. So they're essentially supplying their own energy to do their mining. So they're getting the energy for almost nothing. So, anyhow, So with Bitcoin and the whatnot, and I'm also really worried about government regulation coming to that. I'm in the Bahamas. We actually are the first country. I live in the Bahamas to have our own cryptocurrency. It's called the sand dollar. Nobody uses it. The Bahamas, and the population, a lot of it's a cash economy. Like a lot of the workers that I used when I've been doing this renovation of the house, they don't even have a bank account. I pay them in cash. So it's like, right. I don't know how well a cryptocurrency is going to do here, but they have a thing called the sand dollar, and it's just linked to the US dollar, like the Bahamian dollar. And you can get a sand dollar card. And once, say all the stores, grocery stores, everyone starts taking the sand dollar, I can just go, okay, here's my sand dollar money, boom, coming to your sand dollar account. And that's how I paid for my gas. That's how I paid for my my groceries, etc. So I think that's going to come in to try to compete with these cryptocurrencies, and the governments will make them very, very, very accessible. But also, it's still a very unregulated market. You got these exchanges that get hacked all the time, and coins get stolen. So Bitcoin is kind of like I talked about. You talk about silver. You talk about the small cap juniors. I view it that way. If you want to put 5% of your portfolio or something very small to speculate in these cryptos, that's completely fine. A lot of these cryptos are fronts for very interesting technologies. By the way, I love the blockchain technology. I love it's ridiculous in this day and age. We're still using wires to transfer money. I love the fact that you can transfer some money in Bitcoin and it will be there in 10 minutes. But as opposed to waiting for 2 business or 3 business days for a wire. But the issue I really have is how were these things like how are they regulated? How will they act in a potential bear market, etc.
Definitely. I mean, this year we had kind of the first bear market since Bitcoin came into existence, and it did okay. It was also a year where it had one of its halving processes. Some of these smaller coins have been a little more hit and miss. You've also had, the SEC is starting to look at some of these smaller coins and ones that don't necessarily act like cryptocurrencies. So it's an interesting space, but definitely going to be a volatile one.
And I would say again, like I mentioned, that junior miners being the flaming matches. Right. I think that the coins are like that too. Like there's one called Tron for any of you like kind of sci-fi geeks out there, right? I don't even know what it does. I just know the name of it. And that had a huge spike to 20 cents from almost nothing in January of 2018 during that right. bubble in the coins, that first phase of the bubble. And it's now 2.7 cents, right? So it's off over 85% from its all-time high. And it's kind of flatlining, doesn't really look like it's going to do much. So I think that's another thing too. If you really know that market, I have a friend who does, and that the new technologies, what the new coins do, you can speculate and be in and out. But I just think that a lot of those coins are going to be pump and dumps, and they're going to fade out. And it's kind of like, I know the junior mining market a lot. I know how to trade it. One of the rules I have for a junior is if they double or triple, you got to sell a quarter or half your position. So that's one of the rules I have. Right.
Yeah, just take your original stake out, play with the house's
stake out. And I would say if anybody's trading these coins, you have to do that as well.
Okay, yeah, that makes sense. All right, so we're coming up kind of on the top of the hour here. You've got a newsletter, Addicted to Profits. Tell us a little bit about that.
I'm kind of restructuring the newsletter right now. You'll notice I don't have a lot of posts when you go there right now. We're restructuring it. Actually, if someone were to sign up right now, I'm going to give it for free for the next month during the restructuring. I'll probably start posting a lot more in the new year. But right now, I'm doing a lot of venture work because I'm working. I'm raising money, so I'm giving my subscribers a lot of access to these junior mining deals. To be honest with you, from a financial standpoint, consulting with these companies, etc. I make a lot more money than selling subscriptions. So that's why I've kind of moved to that part of it. But I still trade. I'm actually very active in options. I do, straddles and et cetera, et cetera. And I'm actually not a bad short seller. Shorting has been a nightmare in the last year in the stock market, but I actually have strayed away from it for that reason. I haven't, other than just having pure hedges, I'm not really short right now. But yeah. So we'll do that. We'll do option trades. I'll trade companies. If you're really someone who's interested in precious metals, like I said, I get very good deal flow on these smaller cap companies, and that's kind of where I'm focused right now. But at some point too, I think I'm going to get more aggressive on the short side and hedging side, because in 2008, my hedge was, I'm going to be long gold. And then when the gold stocks fell 70% and gold fell 30%, I was like, well, that didn't work.
You also have same thing this year. You had that kind of that rush to liquidity where everyone just wanted dollars, cash, however you want to define that. And they sold out, gold. They took down Bitcoin kind of overnight while the rest of the markets were closed, just in that rush for cash. So, those are those moments where, like everything will eventually correlate. Yeah.
And like, that's why like I'm always got like at least a 5 or 10% short position, either stocks or via, like short ETF, because when something like that happens, you never know it's going to happen. And I like to use put options because like say every year I'll put 1 to 2% of my money in put options. And I'm like, well, if it's a great year and I make 30 or 40%, and just this year I'm up almost 100% because these gold and precious metal stocks have done so well. But if I make, say, a good year be 30%, I make 28 if my 2% in put options expire worthless. But if the market falls 30 or 40%, that's when these puts can go up 5, 10, 20 to 1. And, if that 2% of your portfolio, makes, 5 to 1 or 10 to 1, boom, you've made 10 or 20. Maybe the rest of your portfolio loses 20, 30, and you're only down 10% when the market was down 30, which is, phenomenal. Right.
Yeah. And I mean, that's better odds than a lottery ticket. And
so I do like to hedge that way. And if, people, ask me, and I prefer to hedge that way too. Cause like, look at anyone who tried to short Tesla there's a guy named Mark Spiegel, and all due respect to Mark, he has a small hedge fund, and he was a guy who used to rant about Tesla every single day. Yeah, and you try to sort Tesla at 50, now that's pre-split or post-split, sorry. Now it's 66. It's $650. That did not work out too good, right? Yeah. Where if you just put 0.5% of your portfolio in some Tesla puts, whatever, it's,
they go to zero, but it's a tiny little bit. You're still moving forward with everything.
So, and like I said, if you can kind of pick and see, I don't try to do that, by the way. I don't try to short the FANGs, Tesla. I haven't been short for a long, long time. After I actually started breaking out of it this time last year, I was like, it's not a good time to be short. I try to short overvalued companies that aren't in dynamic industries. Like one short I like right now in disclosures, I own a little puts on it, is CarMax, because I think at some point that subprime auto market will blow up like subprime prime homes did. And CarMax obviously has car lots, and a lot of those used cars that they sell are financed with subprime and car loans. So anyhow, and they've taken on a lot of debt to expand. And CarMax, during that decline that we're talking about earlier this year, went from $100 to $40, right? So and then now it's only back to 92. So that's another thing too. It's not going to wipe you out shorting a company like that, like say some of these super high volatile tech stocks is. And if you're going to short those tech stocks, I recommend trying to short the ones, like a Zoom or something. Like short the ones that are kind of the second tier ones, right? Like and I have no position in Zoom, just so you know. Yeah. Don't short, like it's easy to look at the charts of Apple and Amazon and Google and just say, they're bubbles, if you look at a 10 or 20-year chart or something. But don't try to short the ones that, everyone owns. And Tesla was a disaster too, because everyone was short Tesla. Like I think at one point, a third of their float was short. So I say try to short. If I do try to short a tech stock or a high flyer, it's always kind of a second tier one, not,
The industry leader,
not one of the main ones.
Yeah.
You know.
All right, that makes sense. Well, David, I'd like to thank you for your time today. Got a lot of interesting thoughts on kind of the inflation trade. Looks like 2021 is going to be a great year for these precious metals. A lot of small cap plays that are going to be some big profit opportunities for people here, especially if government just keeps throwing money at the economy. So, thanks for your time, and from way out in the Bahamas.
Yeah, sorry for my frozen video. I'll work on next time. I'll try to solve that problem.
I'll send you a webcam for next time, and try to get you better hookup. So appreciate the time.
Okay, thanks.
Yeah, thank you. And thanks for joining us here with Wall Street Reporter. Andrew Packer signing off.